Next question. X Limited is engaged in the production of 4 products A, B, C and D. The price charged for the 4 products are 180, 175, 130 and 180 respectively. Market research has indicated that if X Limited can reduce the selling price of its product by ₹5, it will be successful in getting bulk orders and gain a significant share of market of those products. Now, there is one company, namely X Limited, it is producing 4 products A, B, C and D, and the current market price charged are 180 for A, 175 for B, 130 for C and 180 for D respectively. And after a market research, the market research revealed the fact that if X Limited can reduce the selling price by 5, it will be successful in getting bulk orders. So in order to increase the total quantity demanded, or in order to increase the total sales volume, the market research fellows advised the management to reduce the price by ₹5 for each and every product of A to D. The company's profit markup is 25% on cost of product. So the total expected profit from each and every product is 25% on cost. That is 25% on cost means 20% on sales price. The relevant information of product are as follows. Output in units. Total number of outputs A 600 units, B 500 units, C 400 units, D 600 units. Cost per unit. Direct material cost A 40 per unit, B 50 per unit, C 30 per unit and D 60 per unit. Direct labor in rupees 28 for A, 21 for B, 14 for C, 21 for D. Machine hours per unit required 4 hours for A, 3 hours for B, 2 hours for C and 3 hours for D. The 4 products are usually produced in production run of 20 units and sold in batches of 10 per 10 units in a batch. That is, the total production runs of 20 units and sold in 10 units. That is, in each production run, in each batch of production, the total units that has going to be produced is 20 units and the batches are being sold as 10 units in a batch of selling batch. The production overheads is currently absorbed by using machine hour rate, and the total of production overheads for the period is analyzed as follows. So currently the company adopts traditional costing system, absorption costing system, and the overheads has been absorbed on the basis of machine hours, and the total hours, the total cost, production overheads has been given. Machine departmental cost 52,130, setup cost 26,250, stores receiving cost 18,000, inspection quality control cost 10,500, material handling and dispatch cost 23,100. These are all various overheads incurred during the period, and cost drivers has been given in order to calculate the cost as per ABC system. Cost and cost drivers. Setup cost, number of production runs. Stores receiving cost, requisition registry is the cost driver. Inspection or control, quality control, number of production runs is the cost driver. Material handling and dispatch, orders executed is the cost driver. Number of requisition raised in the stores was 100 for each product. For each product, the total number of requisitions are 100. So total number of requisitions, it would be 100 into 4, it would be 400. The number of orders executed was 210. Each order being for a batch of 10 units of a product. So there are 10 units per batch of a product, and total orders executed during the period was 210. Now we are required to compute the target cost for each product, to compute total cost of each product using activity based costing, compare target cost and activity based cost of each product and comment whether the price reduction is profitable or not. Now we have to calculate two things. First of all, we have to calculate the actual cost as per ABC system, cost per unit for producing A, B, C and D by using activity based costing system, and we have to also calculate the target cost. We all know target costing is a new technique, new costing technique, and in this technique we use the term target cost. In the theory portion itself, we have discussed what is the target cost. Target cost is nothing but the cost by reducing the profit expected from that of the selling price. In other words, selling price minus profit is target cost. Target selling price, targeted profit, and targeted cost. If our actual cost is more than this target cost, we have to reduce that actual cost by using various techniques, namely value engineering, etc., product redesigning, etc. By reducing that cost to the total target cost, we can attain the price with the stipulated selling price. So in this new generation technique, namely target cost technique, instead of setting up of price on the basis of cost, in traditional system, the actual system is the total cost will be calculated, certain percentage of profit will be added with that cost, and then we will determine the selling price. But in new generation marketing, in new generation markets, the competition is stiff, the prices are being determined by the market, so the firms, the business organizations cannot determine the prices as such. Instead, by reducing the expected profit from the selling price that is available from the market, we have to set up with this target cost. If our actual cost is not in terms with this total cost, we have to reduce that target cost as such in order to get the expected profit. So how now here in this problem, we are required to calculate that targeted cost for each and every product, and after that calculation of that target cost, we have to calculate whether this target cost estimate can be achieved with this selling price that is available in the market, that is by reducing all those 5 rupees from each and every product, and we have to calculate whether it would be profitable to reduce the selling price by 5 rupees or not. So step number 1, we are going to calculate the targeted cost for each product. So step number 1, computation of target cost. Target cost means selling price minus expected profit. Products A, B, C and D, present price given in the problem 180, 175, 130 and 180. The market research asks the management to reduce the price by rupees 5 per unit. So the targeted price 180 minus 5, it would be 175. 175 minus 5, it would be 170. 130 minus 5, it would be 125. 180 minus 5, the new price would be 175. Again, the market researchers asks the management to reduce price by rupees 5 per unit. The existing price, by reducing it with 5, we can get the targeted or the new price, that is 175, 170, 125 and 175 for each and every product A to D. Now the expected profit. The expected profit is given on cost terms. It is given that the gross margin, the markup expected by the company is 25% on cost. 25% on cost means 20% on selling price. So 20% on selling price, targeted selling price, expected price, expected profit at the rate of 20% of this selling price. So 175 into 20%, which would be 35. 170 into 20%, it would be 34. 125 into 20%, it would be 25 again. 175 into 20%, it would be 35. So this is the price, this is the profit expected. So by reducing this profit expected from that of the selling price, we can calculate the targeted cost. As we mentioned earlier, target cost means price minus profit. So 175 minus 35, the target cost would be 140. 170 minus 34, it would be 136. 125 minus 25, it would be 100. 175 minus 35, it would be 140. So these are all the targeted cost. The firm have to produce A at 140 or less in order to get profit of 35, minimum of 35. B at 136 in order to get a profit of 34 or more. C at 100 in order to get a profit of 25, and have to produce D at the cost of 140 per unit in order to get a profit of 35. As the price is concrete, the price is not being determined by the company. It has to produce these products at these costs in order to get these profits. So these are all the targeted costs. Now let us calculate the total actual cost and has to compare those actual costs with that of this target cost, and have to analyze this decision whether to reduce the price or not. So step number 2, computation of actual cost per unit. As we mentioned earlier, the company uses activity based costing system. We have to find out cost per unit of cost driver. So in calculation of cost per unit as per ABC, sub-step number 1, cost per unit of cost driver, computation of cost per unit of cost driver. There are 5 activity, namely costs, namely setup cost, stores receiving cost, inspection cost, handling cost, machining department cost, and the amounts given directly in the problem: 26,250 setup cost, 18,000 stores cost, 10,500 inspection cost, 23,100 handling cost, and machine department cost 52,130. Now we have to calculate the total drivers upfront. The drivers setup cost has been derived by the total production runs, has been driven by stores, has been driven by requisitions, stores requisitions, inspections has been driven by production runs, handling charges driven by orders, machining charges driven by machine hours. Now you have to calculate the total number of cost units. Setups, as we mentioned earlier, setups has been driven by production runs. So number of production runs we have to calculate. It is given in the problem that each batches produces 20 units. So the total number of units produced is A 600, B 500, C 400, and D 600. So the total number of units 600 plus 500 plus 400 plus 600. The total units is 2,100, and in each batch it is going to produce 200 units. So the total units A plus B plus C plus D 2,100 divided by 20 per batch. So 2,100 divided by 20, it would be 105 production runs. Again, A to D, the total products produced is 2,100, and in each production run, in each batch, it is going to produce 20 units. So 2,100 divided by 20, it would be 105. Now the total number of requisitions, it is given in the problem that each product requires 100 requisitions. Each product requires 100 requisitions, and there are 4 products A to D. So 4 into 100, total requisitions would be 400. Again production runs, so 105 again. Now orders given in the problem directly, there are 210 orders, so 210. Now machine hours given in the problem, the total hours per unit, it is 4 for A, 3 for B, 2 for C, and 3 for D. So number of units 600, so 600 into 4 for A, 500 multiplied by 3 for B, 400 into 2 for C, 600 into 3 for D. So by adding up all those things, that is 2400 plus 1500 plus 800 plus 1800, total number of hours would be 6500. Now by dividing this pool cost with number of units, driver cost per unit can be calculated with. So 26,250 divided by 105, it would be 250 per run. 18,000 divided by 400, it would be 45 per requisition. 10,500 divided by 105, it would be 100 per run. 23,100 divided by 210, it would be 110 per order. 52,130 divided by 6,500, it would be 8.02 per hour. Here we just calculated cost per unit of cost drivers by taking into consideration all those costs and dividing it with number of units. We just calculated cost per unit of cost driver. These figures has to be taken into consideration while calculating ABC system of costing. So now let us put these figures into the next table. So computation of total cost and cost per unit using ABC. We just calculated cost per unit of cost driver as per ABC. Now let us put all those figures in order to calculate cost per unit of A, B, C and D. So particulars column A, B, C and D. Now there are two direct items, namely direct material and direct labor. After that, various overheads. So direct material, 600 units of A, per unit requires 40 rupees material. So 600 into 40, it would be 24,000. Likewise B, total units 500, 50, 500 into 50, 25,000. C, 400 units, 30 per unit. So 400 into 30, it would be 12,000. And for D again, 600 units of D, 60 rupees of material, 600 into 60, it would be 36,000 for D. Now labor part, the direct labor 28 rupees for a unit and 600 units of A, 600 into 28, it would be 16,800. B, total units 500, per unit labor 21 rupees, 21 into 500, it would be 10,500. C, 14 into 400, it would be 5,600. D, 21 into 60, it would be 12,600. Now on to our overhead parts. We just calculated, as we are calculating as per ABC system, we are going to give it activity based. That is first one, setup activity cost. As we all know, setup activity cost is driven on the basis of total production runs, and production runs, A it is 30, B it is 25, C it is 20 and D it is 30 again. And per production run we calculated setup cost of 250 per unit, so that 250 multiplied by the total production runs, that is 30 into 250, here it would be 7,500. And again that 250 per production run setup cost into 25, it would be 6,250. 250 into 20. Now the third item, namely setup activity cost. This setup activity has been driven by number of production runs. Production runs of A 30, B 25, C 20 and D it is 30. And per production run setup cost is 250. So that 250 has to be multiplied by each and every production runs. So 250 into 30, it would be 7,500. 250 into 25, it would be 6,250. 250 into 20 of C, it would be 5,000. And 250 into D's production runs 30. So 250 into 30, it would be again 7,500. That is just multiplying number of production runs per each product into production runs at time of cost per activity, that is 250. 250 into 30, 250 into 25, 250 into 20, and 250 again into 30. Now the second activity, namely stores receiving activity, the cost driver being requisitions. It was told in the problem that requisitions 100 each for each and every product, so that 100 multiplied by 45 cost per requisition for stores receiving. So 45 into 100, it would be 4,500 for each and every product. 45 into 100, 4,500 for each and every product. Now on to the third one, namely inspection or quality. This inspection and quality again on the basis of production runs. Production runs 30, 25, 20 and 30 each. So the total cost was 100. So 100 into 30, it would be 3,000. 100 into 25, it would be 2,500. 100 into 20, it would be 2,000. 100 into 30, it would be 3,000. Now on to the next activity, namely handling or dispatching activity. It was told in the problem that this being driven by the number of orders, and the orders are 64A, 54B, 44C and 64D. So that 60 multiplied by 110 per order, calculated in the previous table. 110 multiplied by 60, it would be 6,600. 110 multiplied by 50, it would be 5,500. 110 multiplied by 40, it would be 4,400. That 110 multiplied by 60, it would be 6,600. This is how the handling and dispatching charges has been allocated with. Now on to the last activity, namely machining activity. And this machining department activity is being driven by the machine hours, and the total machine hours for A, total output, it is 600. So the total machine hours being 600 into 4, 2,400. So on that basis, 2,400 for A, 1,500 for B, and 800 for C, and 1,800 for D. On the basis of that, we have to multiply it with 8.02, which was calculated in the previous table. So 8.02 cost of machine hours per hour. So 8.02 multiplied by 2,400 machine hours, 2,400 into 8.02, it would be 19,248. Now for B, 8.02 multiplied by 1,500, 12,030. Now for C, the total hours being 800 and per hour rate being 8.02. 8.02 multiplied by 800, 6,416. For D, 8.02 multiplied by 1,800, 14,436. 14,436. So these are our various overheads. We have to sum up all those things. So the total cost can be calculated. So the total cost of A, by adding up all those figures, it would be 81,648. For B, it would be 66,280. For C, it would be 39,916. For D, it would be 84,636. Now we have to calculate per unit cost. Per unit cost by dividing it with number of units. Units 600, 500, 400 and 600. So cost per unit by dividing it with total number of units. 81,648 divided by 600, it would be 136.08. 66,280 divided by 500 units, it would be 132.56. 39,916 divided by 400 units, it would be 99.79. 84,636 divided by 600 units, it would be 141.06 rupees. So these are all the actual cost per unit. We just calculated this actual units by dividing it with the total cost with that of total number of units. For calculating total cost, we can broadly classify this into two categories: direct category and overhead category. Direct category directly from the problem. Now we just calculated this costing, these figures on the basis of activity based costing technique. For that, we just calculated cost driver per unit, and by multiplying it with the number of units for each and every product, we calculated the total cost. From that total cost, we calculated cost per unit. Now this actual cost per unit has to be compared with our targeted cost. In the first table itself, we just calculated how much cost can be incurred to produce A in order to get a profit of 35, B in order to get a profit of 34, C 25, and D 35. Now these targeted cost has to be compared with actual cost and have to conclude whether the decision to decrease the price by ₹5 is viable, that is profitable or not. For that purpose, we have to draw up one more table, comparison table. There are 4 products: A, B, C, and D. Actual cost can be taken from this table: 136.08, 132.56, 99.79, and 141.06. Now targeted cost: A 140, B 136, C 100, and D 140. Let us put all those figures here again. A 140, B 136, C 100, D 140. So these were targeted costs. So A can incur per unit cost of 140 or low. If it is incurring 140, it can get that expected profit, that is 25% on cost. So here, as the actual cost is lower than 140, before that let us calculate the differences between this actual cost and targeted cost. It would be negative 3.92, B it would be negative 3.44, C it would be negative 0.21, whereas D would be positive 1.06. So in all those 3 cases of A, B, and C, the actual cost is lower than that of the targeted cost. So there is not at all any need in order to reduce the actual cost by using value based engineering technique in order to get the expected cost profit, that is 25% on cost, in other words 20% on selling price. But the only issue is regarding the product D. If we are going to reduce the price by 5, it is going to reduce the profit 1.06 per unit, that which, as the targeted cost cannot be achieved, or 1.06 rupees is incurring more than that of the actual cost. So here the value engineering is required only in case of D. We have to reduce this extra 1.06, then only we can achieve the targeted profit, that is ₹35 per unit of D. In all the other cases, as the actual cost is lower than the targeted cost, the price reduction of 5 can be easily adopted with, but only in case of D, if it has to get at least a profit of 35 per unit, that is 25% on markup on cost or 20% on sale price. it has to reduce that extra cost of 1.06 by using any value engineering techniques or product redesigning, etc. So this is the conclusion. For A, B and C, the profit can be achieved with. Only for D, that value engineering technique has to be adopted in order to get the expected profit. Now one illustration on target costing. A company has a capacity of production of 80,000 units and presently sells 20,000 units at rupees 100 each. So the total installed capacity is 80,000 units, whereas the company is only selling 20,000 units at rupees 100 per product. The demand is sensitive to selling price, and it has been observed that every reduction of rupees 10 in selling price, demand is doubled. So as we know, the demand price theory, in the demand theory itself, it has been stated that due to decrease in price, the total demand would tend to increase if the other things remain unchanged. So here the sensitiveness, the price elasticity in such a way that if we decrease selling price 10 rupees, the total demand of that product would be doubled from the present level. Say right now the price is 100, if we reduce it to 10 rupees, reduced by 10 rupees, that is to 90 rupees, instead of 20,000 units, we could sell 40,000 units. Likewise, if we go on decreasing 10 rupee, 10 rupee, 10 rupee, the demand would be doubled and doubled and doubled for every decrease of 10 rupees. What should be the target cost at full capacity if the profit margin of sale is taken as 25%? So here we have to determine